If you're a financial advisor with retired clients or near retired clients who have paid off homes or homes that are close to being paid off, there is a very specific advantage of the home equity conversion mortgage that can help your client grow guaranteed liquidity over time. In today's video, I'm going to walk through the home equity conversion mortgage line of credit and talk about how you, the fiduciary, can put that line of credit to work for your clients. And remember, I always advise my clients to check with a licensed financial professional and their family before they make this or any other major financial decision. Now, sit back and get ready to learn the truth about reverse. If this is your first time here, please like this video, subscribe to the channel, and be sure to tap that bell for notifications so that you can keep learning right along with us. And if you have specific questions about the home equity conversion mortgage, or you just want some more information, please feel free to reach out. My contact information is in the description right below. Today's video is for financial advisors. We're going to get a little bit technical here. And so I'd like for you to first consider your clients. How many clients do you have who are over 62 and who are either in retirement or nearing retirement? And of those, how many have paid off homes? How many have homes that are close to paid off? It's probably going to be a pretty hefty number because we counseled our parents and grandparents to pay off their homes. And so by and large, that generation has stored an enormous amount of wealth in the home. And as we know, that wealth is illiquid. And while you might be considering the home's overall value and considering the appreciation of home in the long-term financial plan, it's still a fixed long-term illiquid asset. So you're affecting net worth, but it's not liquid. And if it's not liquid, you can't put it to work. And so there are two things that are keeping the fiduciary community from adopting the home equity conversion mortgage. And the first one is the social construct. It's this idea that we're supposed to pay off our homes and we're supposed to pass the home down to the next generations. That's actually created this imbalance. Because by and large, most of your clients, their largest source of overall wealth will be their home. And they've spent 20, 30, 40 years making payments on a mortgage in an attempt to pay that home off. But what happens when the home is paid off? Or what happens when your client is storing hundreds of thousands of dollars of illiquid home equity in this fixed asset that you can't really consider in the overall portfolio? This is the exact reason why the home equity conversion mortgage was created in the first place. Because in the aggregate, there's $13 trillion of home equity just sitting there. And by and large, it's not used. It's not put to work in the retirement plans for just this reason. And so the home equity conversion mortgage is the instrument that will allow you, the fiduciary, to manipulate and manage and maintain a safe and intentional portion of your client's home equity in a fashion that is both guaranteed and liquid. Now, in terms of numbers, I'm going to speak in very general terms, but essentially the home equity conversion mortgage lends a specific percentage of the home's overall value. And so we look at two factors. Number one, the age. The younger the person is, the less of a percentage that we will lend. And we also look at interest rates. The higher the interest rate, the less we will lend. And so right now we're in a marginally high interest rate environment. Rates are between 6.5% and 7%. And so someone who is in their early 70s, let's say they have a $600,000 home, after closing costs, that will yield about a $200,000 line of credit. And this line of credit is attached to your client's checking account. It can be used for anything. It spends just like cash. And so the first thing that you, the advisor, have created from a portfolio perspective is prior to putting this in place, your client had a $600,000 fixed asset that perhaps you were considering the appreciation and the overall net worth, but you didn't have a way to, number one, manipulate that wealth, and number two, to include it on the execution side of the retirement portfolio. And so now, simply by putting this in place, you have created $200,000 of liquidity from a previously illiquid source. Now, this home equity line of credit, number one, it's guaranteed to be permanent. It can never be shut off. And so as long as your client occupies the home, that line of credit is permanent. And so you can factor that permanence into the overall financial plan. More importantly, the strategy that we espouse, and this strategy comes from Dr. Pfau, who is the professor of retirement income at the American College of Financial Services. He actually ran the Retirement Income Certified Professional program, and he is considered, at least by me, the godfather of the modern reverse mortgage because he figured out how to take this instrument and integrate it into the plan. And the strategy is very simple. Put it in place early, so establish this line of credit as early as it makes sense, with the intent to take advantage of something called the line of credit growth. And so, as a starting line, we've created this $200,000 pool of liquidity. Well, this liquidity, one of the advantages of it is it grows over time. The available portion of the line of credit will grow at the interest rate of the note, and that's guaranteed year over year over year. And so just by putting this in place, you've effectively got $200,000 of liquidity growing at right now around 7% compounding monthly. And so this becomes a very real way to build additional liquidity. So the strategy is put this in place early, take advantage of compounding, and use the home equity, use that equity later in life as it's needed. So one of the biggest concerns about a reverse mortgage is the idea that I'm going to use up all my equity. Well, first of all, the home equity conversion mortgage only lends between 30 and 55% of the home's value, depending on age and rate. And so putting it in place does not put all of your home equity at risk. Second of all, the strategy is not necessarily to spend your home equity. It's to position it. And so putting this home equity conversion mortgage in place, putting this line of credit in place, positions it for guaranteed liquidity growth over time. And so consider this $200,000 line of credit 10 years down the road. Now it's $400,000. And as our clients age into the time when they're going to start needing long-term care, you have this pool of wealth that's available that you can use to mitigate long-term care risk. You can use it to mitigate sequence risk, and you can use it to mitigate longevity risk. Further, once we are prepared to start taking funds from the line of credit, once we're prepared to actually start drawing from it, there are a number of different mechanisms and plans that we can use. You can take ad hoc withdrawals at any time. I would consider using that for large household expenses like replacing your air conditioner. You can also set up structured monthly payments. And that is, you can set up a given amount for a given number of months. Say if you're going to bridge to Social Security. You might draw from the reverse mortgage monthly to augment the income until you're ready for your client to take Social Security. You can also set up something called a tenure payment, and that's spelled T-E-N-U-R-E, like a professor's tenure. And this effectively works like a housing annuity. With a tenure payment, your client will receive a monthly payment of N number of dollars per month indefinitely for as long as they stay in the home. And so if we are income challenged, the tenure payment is one way to put a guaranteed cash flow stream in place. Finally, there's something called a life expectancy set aside, or LESA, a LISA, what we call it for short. And this provision sets aside a portion of the line of credit to automatically pay the property taxes and the homeowner's insurance over the life of the loan. Now, sometimes we actually require it as part of the qualification if we have a marginally qualified client, but it can also be a great way for you, the advisor, to kind of out of sight, out of mind, have those taxes and insurance automatically paid. The point being here is that the home equity conversion mortgage gives you a puzzle piece. It gives you a lever. It gives you access to wealth that you didn't have access to before. And so in this previous example, your client had a theoretical $600,000 fixed asset that you could do nothing with. And now simply by putting this home equity conversion mortgage in place, you've created $200,000 of liquidity, you've created guaranteed growth, and you've created a way to position a portion of that home equity into the retirement execution plan. For example, a lot of our clients are using this line of credit as a hedge against long-term care expenses. Long-term care is a huge expense, we all know this. And so our clients who have paid off homes are setting this line of credit up early and letting it run with the intent to use those funds for long-term care, either to bring care into the home or if it's a spousal situation, to send that first spouse to long-term care. The idea is to have those funds at the ready. And because you've had them growing over time, that pool of wealth is pretty enormous. And so you, the fiduciary, now that you have this in place, you have this vehicle that, number one, is permanent, number two, has guaranteed growth associated with it, number three, is tied to the interest rate of the loan, you now have a way to plan and execute a specific amount of home equity into the retirement plan. The home equity conversion mortgage allows us to consider a pool of wealth that is enormous, over $13 trillion in the aggregate. And right now, that massive pool of wealth, by and large, is not being used. The home equity conversion mortgage gives us the instrument, it gives us the means to put a safe and intentional portion of that equity to work and help our clients live out their best possible retirement. Until next time, keep on learning the truth about reverse.